The stock market has performed well so far this year as we near the midpoint of 2024, but the back half of the year will bring new challenges and new opportunities with presidential elections, possible changes in central bank policy, geopolitical factors, new innovations in technology, and more. Hello and welcome to the Cedar River Capital Market Touchstones slideshow update for the second quarter of 2024. The date today is June 18th, 2024, and today we'll be discussing these and other factors driving stock and bond markets. My name is Paul Latta. I'll be doing the narration today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. Our agenda today will begin with a discussion about the recent market action, then we'll look at the macroeconomy to put some backing behind the market discussion, and then we'll move to a microeconomic view and look at key industry-specific drivers. We'll then conclude with a longer-term observation about the investment landscape. The stock market does remain in a bull market formation. The S&P has done well over the last year as well as over the last 5 years, as you can see in these two charts. The trend has not been straight up, of course. There have been dips along the way, but we're up 26.1% in the last 12 months as of June 13th, and we're up 104.3% in the prior 5 years. The bond market has been fairly flat year to date, and over the last 12 months has seen a total return of 3.6% as of June 13th, as shown on the chart at the left. However, the bond market has not really recovered from the sell-off back in 2022 amid the Fed's rate hiking campaign, as shown on the chart at the right. Still, the 5-year total return remains very modestly in the black at 0.4%. A more dovish Fed would certainly be welcome. The Fed's higher for longer mantra has kept the bond market from mounting a meaningful recovery. The Fed's rate hiking campaign ended in July last year, as you can see in the chart here. And since then, it's been in a holding pattern with overnight Fed funds set at a range between 5.25% and 5.5%. Consensus among investors and among Fed governors is that rates will be headed lower, also as shown here in the chart. Timing of the first cut is proving a longer wait than many expected, though we ought to get at least one cut, perhaps two cuts before the year end. This is the Fed Watch tool from the Chicago Mercantile Exchange, which is showing in the blue square on the second line that the first rate cut is most probable at the September 2024 Fed meeting, and that we are likely to have a second Fed rate cut at the December Fed meeting. This is actually only slightly more dovish than the Fed's internal dot plot, which projects only one rate cut in the back half of the year. These rate cut probabilities are a moving target, of course, and they change every day based on commentary from the Fed as well as economic data such as consumer price index, unemployment, and much more. In our slideshow from last quarter, we talked about how the vast majority of central banks had paused their rate hiking campaigns and were in a holding pattern. You can see this in the right-hand column of this table. But since then, a handful of central banks have come off the sidelines with rate cuts, especially in Europe and Latin America, and you can see that in the second column to the right on this table. This reflects patches of economic weakness mainly in those regions. In contrast, the US and Asia still remain on hold, though as we saw on our prior slide, the US is likely to make its first cut in September. One side effect of the delayed rate cutting in the U.S. is that the U.S. dollar remains strong, mainly reflecting interest rate parity. That is, the higher money market rates in the U.S. are driving inflows from other regions of the world, which is supporting the U.S. dollar. We've had a deep yield curve inversion for over a year now. That is, long-term interest rates are actually lower than short-term rates. As you can see on the top right of the slide, the spread between the 10-year Treasury and the 2-year Treasury is now a negative 0.38%, or negative 38 basis points. As you can see in the chart here, prior yield curve inversions preceded recessions by 1 to 2 years. So worrywarts are right to be concerned. Indeed, outside the U.S., yield curves in most of the developed world are also inverted, and several countries, especially in Northern Europe, have been in technical recession in the back half of last year. That said, economic growth in the U.S. still remains positive, and the inversion is not as deep as it was in the middle of last year when the spread exceeded 100 basis points. Back to the stock market now, and the key factors driving investment there as shown here. We've already discussed interest rates, but let's look at these other factors too. Let's begin with valuation. The market valuation is modestly above the middle of its historic range. This chart shows the last 10 years of the S&P 500 in blue and the PE ratio of the S&P 500 in purple. As you can see, the S&P gained 238% over the last 10 years. In purple, you can see the price to earnings ratio has ranged from 14 times to 24 times over the last 10 years and is presently at 21.1 times, which is on the high side but still within the historic range. This slide is a regular feature of prior slideshows because, well, it's one of our favorite slides. It compares the earnings yield on the S&P 500 to the yield on the benchmark 10-year Treasury bond. Whichever line is higher is the better value with this approach. As you can see, stocks remain the better value, but the higher rate environment has narrowed the lead considerably. We've been buying bonds in the last year or so, reflecting the more reasonable bond market setup. Money on the sidelines has indeed increased, as you can see in the chart here. We now have retail money market funds well over $6 trillion. Higher rates have been, of course, the key driver. Certainly higher rates are more attractive to savers. But also with the yield curve inversion and related recession threat, cash is a safer vehicle than nearly all other asset classes. Eventually, of course, rates will decline, as we discussed in slide 6. In past periods of peak cash levels like 2008, 2003, and 1991, the stock market rallied strong in subsequent years. Looking at the stock market in just the year to date for 2024, the S&P 500 rallied 14.6% through June 14th. Where did that gain come from? This has actually been one of the most discussed topics on Wall Street in recent months, since one single stock, Nvidia, accounted for nearly a third of the gain for the overall S&P 500. As you can see in the table here, Nvidia's contribution to the S&P 500 was an astounding 4.45%. Further, the next 5 biggest contributions came from the remaining 5 of the FanMag names. FanMag is an acronym for the big 6 consumer tech names: Facebook, Amazon, Nvidia, Microsoft, Apple, and Google. The big driver for the FanMags here has been the hype and the reality around artificial intelligence and the related FOMO, or fear of missing out. The imbalance has left the remaining 494 stocks in the S&P 500 well behind. In fact, the average gain for all stocks in the S&P 500 was a mere 4.2%, less than a third of the headline gain of the S&P 500 index. Year-to-date investment returns by sector show the technology and communications sectors leading the pack. Of course, these are the sectors that have been driven by the sizable gains on Nvidia and its FanMag cousins. The real estate sector, in contrast, has lagged, likely reflecting just simply higher interest rates and the related higher money market rates, which reduces the attractiveness of dividend-oriented stocks like real estate. Consumer discretionary sector is also weak year to date, likely reflecting the sizable weighting of Tesla, which has been troubled this year with lower margins, possible elimination of electric vehicle tax credits, and price cuts and other factors. The style factor breakdown year to date also reflects the impact of the FanMag moves. The styles that did best were those with the greatest exposure to Nvidia and to a lesser extent exposure to the other 5 FanMags. It's interesting that those styles that outperformed in the first quarter also outperformed in the second quarter, albeit not in the same precise ranking. Also, those styles that underperformed in the first quarter again underperformed in the second quarter, and again not in the exact same ranking. The U.S. market has outperformed nearly all other developed markets in 2024 so far, as shown in the table here. However, most of that excess return has been due to the FanMag stocks. In contrast, the S&P 500 Equal Weight Index, which does not assign higher weights to the FanMags, shows a more representative gain of 4.2%, which is right in the middle of the pack and actually just below Europe, which is at 4.45%. Turkey tops the list here, mainly rebounding from last year's drubbing on a controversial central bank policy, a policy that has since been reversed. China shares are again seeing mixed performance depending on whether you look at the H shares trading in Hong Kong, the A shares in Shanghai, or the N shares in New York. Latin America has been notably underperforming so far this year. This appears to be driven by an interest rate disparity as the central banks in Latin America cut rates, but the U.S. Federal Reserve remains on hold. We've seen this before when select currencies soften on the U.S. being comparatively more hawkish. This was the origin of the Fragile Five problem of 2013 and 2016 that rippled through the currencies of India, Turkey, Brazil, South Africa, and Indonesia. If the Fed cuts rates in September, as consensus suggests, fears of currency devaluations ought to dissipate. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin by looking at gross domestic product, GDP levels by country. In our slideshow last quarter, we discussed how strong the U.S. economy was in the back half of 2023, and we also discussed how weak the European economy was in the back half of 2023, with several countries entering technical recession. But in the first quarter of 2024, these two trends reversed. The surprisingly strong U.S. economy softened meaningfully in the first quarter with GDP growth of a mere 1.3%, and all but one of the European economies experienced economic expansion in the first quarter, a reversal from the contractions of the prior two quarters. In Asia, China is improving, but it's extremely weak compared to where it was 15 years ago in its glory days. South Korea is gaining traction. However, Japan appears to be cycling between strong and weak in the last several quarters. Latin America is generally seeing more expansion than contraction at this point. Looking deeper into the U.S. economy, the employment situation appears healthy when looking at just the headlines. Unemployment and non-farm payrolls both remain solid. However, the lower profile household survey data do not line up with the establishment surveys, creating some level of confusion amongst economists. The household survey shows faltering growth in payrolls, a conclusion that seems to corroborate with soft job openings. We are inclined to side with the lower profiled household survey here. This does not mean the labor market is troubled, rather it just means the labor market is mediocre at this point. Overall consumer confidence levels have been steady for the last 2 to 3 years. However, digging down to the subcategories, it's interesting that consumers remain quite confident in their present situation, but are more circumspect about the future. The discrepancy has been with us since about 2021 and seems unlikely to change. Outside the U.S., most consumer confidence indices are showing similar levels to those in the U.S., coming in just below pre-COVID levels. Inflation continues to moderate in most countries, but not at the same rate. For the U.S., the Consumer Price Index peaked at 9.1% in June of 2022 and has since dropped to 3.3% as of May 2024, the most recent month for which CPI data is available. While the CPI has dropped fairly consistently month to month, the decline has been a bit slower than consensus forecasts. Most other developed countries also saw inflation peak in mid to late 2022 and drop to lower levels, but present levels of 2.2% to 5.2% are still above the 2.0% target. So while central banks may have started cutting rates, most still remain in pause mode. Two outlier countries here include Russia and China. Russia inflation remains high due to the Ukraine situation, and China inflation remains low, mainly due to economic weakness. U.S. inflation of 3.3% remains above the target 2.0%, which begs the question, where are the price increases coming from? As you can see here, the shelter costs in yellow remain the biggest component of inflation. Note here that shelter cost is not measured using home prices, but rather uses monthly equivalent rent. This acknowledges that most home buyers use mortgages and are not cash buyers. Our last topic on the economy here, but this is an election year. Indeed, The Economist described 2024 as the biggest election year in history, since elections are taking place in 64 countries plus the European Union. The elections represent over half the world's population. Some of these elections are not truly free elections, like Russia, for example. Also, many of the elections have already been completed, like those in Mexico and in India. However, economists mainly seem to be focused on election year fiscal spending and related economic support. The concern is that a post-election year reversal in global fiscal spending could lead to a soft global economy, perhaps even a recession. Speaking of fiscal spending, U.S. debt levels remain at post-World War II highs, as shown here now at just over 120% of GDP. While fiscal spending and tax cuts and government support are popular, increased debt levels, of course, are concerning. We've used this slide in prior slideshows. This is a consensus opinion curated from a variety of mainstream financial media sources showing which sectors are likely to do well under which president, Biden or Trump. Again, the most consistent sector bias is big tech being Democrat and big oil being Republican. This does not mean Democrats will be skirting or avoiding big tech issues on antitrust or tax changes, nor does it mean Republicans will be quickly drilling various wildlife refuges. Other consensus Democrat biases seem to be in favor of renewables, electric vehicles, media, and to a lesser extent Mexico. Other consensus Republican biases include banks, materials, trucking, firearms, and Russia. The Russia bias, of course, is more of a bias in favor of oil rather than a statement about the war in the Ukraine. Notably, some issues that were formerly one-sided have become a little bit more bipartisan. China's at the top of the list there. Immigration seems to be headed in that same direction. Also, defense seems to be headed from an historic Republican bias into more of a bipartisan issue as Democrats seem more intent than Republicans on funding the Ukraine war against Russia. Just a reminder that the stock market returns in election years over the last century are not that much different than stock market returns in non-election years. Specifically, election years return 11.6% on average, but non-election years average 10.4%. However, there is profound variability from election to election. This, of course, reflects the fact that the stock market is about more than who is president. It's also about things like global pandemics, Fed policy, subprime crises, wars, new technology, fashion change, and many other factors. We'd now like to move on to part 3 of our slideshow, shifting from macroeconomics to microeconomics, by looking at a handful of industry-specific factors that are shaping overall capital markets. Today we'd like to highlight 5 industry discussion topics. First, what are the transports telling us, in particular with regard to the economy? Second, insurance stocks have done really well. Where are we in the insurance cycle now? Third, why are the base metals diverging? Some are up and some are down. Fourth, merchant power stocks have been on fire. Can we reconcile this with the fundamentals? And then lastly, is the IPO market finally coming back to life? What and where is the appetite for new issues? Beginning with the transports, for those schooled in basic Dow theory, the role of the Dow transports goes hand in hand with the role of the Dow industrials. According to the theory, a bull market is only a bull market if the companies that make stuff, the industrials, and the companies that ship stuff, the transports, are both in bull formation. The challenge with Dow theory is that the industrials of 100 years ago are not really the industrials today, nor are the transports of 100 years ago the same as the transports of today. Freight transports break down into 4 categories as shown on the table here. The main distinctions between the freight categories is whether the goods are global versus domestic, and whether the goods are at the raw material end of the value chain or at the finished good end of the value chain. The reason for the distinction is that a US-only recession will weigh heavily on air and truck freight, but not on ocean freight and rail freight. US-based trucking and air freight are strongly correlated with the US economy. However, a recession in most of Europe and Asia, but not the US, will likely weigh on the US rail carriers and US ocean shippers, but not the US air freight and US truck freight. By looking at which modes of U.S. transports are succeeding or failing, one could get a sense of economic strength both inside and outside the U.S. This table looks at the earnings revisions over the last year for representative companies in each of the 4 major modes of transport. All transport sectors have seen downward revisions, but that downward revisions are not equal. The trucking sector in particular has seen a notable collapse in earnings estimates. This ought to be a concern since trucking is actually the best economic indicator for the U.S. economy. However, the second best economic indicator, air freight, has seen the least downward revisions. The 2 other modes, ocean freight and rail, well, they've held up reasonably well, not quite as well as air freight, but not at a level that is concerning. Our read here is that air freight earnings are vulnerable, and if air freight does in fact soften, well, America might be skirting a recession this summer. Insurance stocks have been outperforming the S&P over the last year, as you can see in the chart here, with some names like Progressive turning in especially strong gains. We have been in an insurance upcycle, but how much longer will that cycle extend? An examination of the present upcycle begins with looking at the last down cycle. The year 2022 was a very challenging year for most insurance companies, mainly due to the Fed rate hiking campaign, but also due to the bear market in stocks in the same year. Most insurance company balance sheets are heavily populated with bonds, and with 2022 being the worst bond market in a century, nearly all insurance companies took huge mark-to-market write-downs on their bond portfolios. The write-downs hit book values hard, as well as equity capital adequacy ratios. Book value declined 38% in 2022 on average here as shown in the table. However, life insurance companies with annuity portfolios were even under more pressure as the weak stock market forced write-downs on the deferred policy acquisition costs. MetLife book value dropped nearly 60%. Lincoln National book value dropped over 90%. Deferred policy acquisition costs do not get marked to market, so unlike bond portfolio write-downs, such write-downs are permanent losses of capital even with a recovering stock market. With the Fed no longer raising rates, bond portfolios are no longer getting marked lower. Book values have recovered, though partly due to premium increases and lower combined ratios. The The near brush with death has been a key factor behind the ongoing hard market for most insurance companies. Premium increases have been meaningfully positive within the property and casualty sector since just before COVID. This reflects four factors. First of all, low rates on the embedded bond portfolios. Second, increased frequency and severity of catastrophe losses. Third, less reinsurance availability. And lastly, the ease of price increases in an inflationary environment. So the cycle is remaining harder for longer and seems unlikely to be softening anytime soon. Moving from property and casualty insurance to life insurance, while the variable annuity lines were troubled in 2022, the higher rate environment has been a sizable tailwind for fixed rate annuities. Fears of market volatility are adding fuel to the fire. Indeed, the gains in fixed annuities are more than offsetting any modest weakness in variable annuities. This tailwind may persist given the Fed's higher for longer mantra. Copper prices lifted sharply this quarter, a performance that was not matched with other base metals. Indeed, most base metals like ferrous or iron ore actually declined in the second quarter. So too did other same cycle commodities like kraft pulp and polystyrene and others. It appears we are in a bit of a short-term copper bubble driven by a short squeeze on Western metals exchanges after Biden restricted imports of non-ferrous Russian metals in April. So copper inventories gapped lower on the London Metals Exchange and on the Chicago Mercantile Exchange, but the inventories gapped higher in China and elsewhere. Higher demand was not really a factor in this price move, despite the ever-present idea that copper demand and prices will rise due to demand from artificial intelligence hardware and from electric vehicles. Indeed, a reversion in copper prices is very likely. Copper is a global commodity, so excess supply in China means that China will simply ship all of its non-Russian copper to London and Chicago. Does this mean that ferrous is interesting now as a buy? Well, it is actually looking more interesting, but it does seem like we're a bit early. The merchant electricity companies have exploded to the upside in the last year, with at least one merchant electricity company, Vistra, even outperforming the market darling NVIDIA. Peers Constellation Energy and NRG were not far behind as shown in the chart here. Are the merchant energy companies entering the chip industry to compete directly with NVIDIA? Why are these stocks on fire? Indeed, the merchant energy story is intimately tied to NVIDIA. Additionally, the merchant energy companies are tied to the growth of electric vehicles. Well, what are the connections? Headlines over the merchant sector center on the explosive growth of electricity demand associated with the new data centers needed to support generative AI. McKinsey puts that figure at 800 terawatt hours of new electricity generation capacity needed by 2030. Last quarter, the PJM Interconnect, the biggest wholesale electricity interconnect in America, well, they doubled their forecast for electricity demand by 2030. Further, electricity demand from increased electric vehicle penetration is tapping the grid at the same time. Electric vehicle unit sales have tripled since 2021, and electric vehicles, well, they draw a lot of electricity. Two electric vehicles are actually equal to one household worth of demand. The Rocky Mountain Institute trumps McKinsey, saying that 1,500 terawatt hours of new electricity demand by 2050, mainly due to electric vehicles. So the demand story is resonating powerfully with investors. Recent earnings seem to seal the case for high demand, as all three merchant electricity companies have seen persistent upward earnings revisions, and all three project ongoing earnings growth. While this story is really compelling, the reality is that most earnings modelers, well, they're actually kind of ignoring the story. There's a deeper reality, and we'll talk about that on the next slide. The circle at the center of this slide is the conclusion here. There really is no meaningful tie between merchant electricity earnings and artificial intelligence or electric vehicles. Well, that's kind of a country mile away from the conclusion that Google or ChatGPT will arrive at. Let's look at the right side of the slide first. That so-called explosive growth of electricity demand is actually incredibly tiny. The impact artificial intelligence and electric vehicles combines to lift annual electricity growth from the prior estimate, this is from the PJM, of 1.3% to the new estimate of 2.2%. Technically, that is nearly a doubling like the press release says, but those are really tiny numbers. It may be hard for computer users to understand that computers, including data centers, really only account for 3% of U.S. electricity demand. Further, electric vehicles are presently adding only 0.2% of incremental growth through 2026. Most folks that do not follow the utility industry are not aware that the vast majority of electricity use is actually for heating and cooling stuff. It's not for computational or communication items. Now let's look at the left side of the slide. The so-called earnings growth at the merchant power companies partly reflects the huge hit to earnings from the 2021 and 2022 Texas freeze. And recent upward revisions in earnings mainly reflect the Texas ERCOT electricity prices popping 100% on a very high temperature forecast. Indeed, with soft natural gas prices, spark spreads are at all-time highs. So for the last 3 years, nearly 100% of the so-called earnings growth reflected better weather. That does not sound like a sustainable business model. Wow, the merchant power companies have basically no ties whatsoever to artificial intelligence and electric vehicles. If merchant power was being driven by artificial intelligence and electric vehicles, then such a phenomenon would not be limited to just the US. After all, artificial intelligence and electric vehicles are moving throughout most of the developed world through Europe, Japan, and other developed countries. However, when looking at merchant electricity companies in Japan and Europe, well, they're not really tracking NVIDIA 200% higher. Indeed, most of those are troubled with lower stock prices and lower earnings estimates. Where is that artificial intelligence and electric vehicle tailwind? Well, it seems it was never there. Merchant electricity, of course, has a troubled history. The Enron scandal comes to mind here. So too does the bankruptcies of Calpine and Dynegy and various other peers from 20 years ago. Indeed, earnings modelers generally regard this sector as one of the most difficult to forecast earnings on. It's up there with property and casualty insurance and airlines and the other extremely difficult to model companies. Amid that fog of undecipherable earnings, the stories have a tendency to rise above the reality, but eventually reality will reassert itself. To a point there, Morningstar is actually using price targets nearly 50% below the present price levels. Investment banking analysts generally have higher price targets, of course, but a reconciliation between the story and reality will happen at some point, likely in the next several quarters. We're not inclined to be long on these names. In the early part of the year, some of our erstwhile investment banking colleagues seemed hopeful that a recovery in the IPO market was at hand. Indeed, January started reasonably well, but subsequent months have shown only limited deal flow. At some level, this should not be a surprise since the story stock style factor on slide 15 finished near the bottom of the league table in the first quarter and in the second quarter so far. Most investment bankers we chat with are not expecting a return to the levels of 2020 or 2021, which were, of course, the biggest IPO years since the late 90s dot-com bubble. And after all, many of the COVID-era IPOs are actually still around and languishing at penny stock levels and kind of tainting the attractiveness of the IPO process. Still, some level of bounce from here will eventually arrive, though we suspect it is not imminent. A quick look here at the top dozen IPOs in 2024 so far, ranked by deal size. This is a bit of a mixed bag with some tech, some biotech, some industrial. Post-IPO performance is also a mixed bag with some gains over 80% for Astera Labs and losses of 64% for Kymeva Therapeutics. Perhaps one notable observation is that very few companies on the list are pitching themselves as an artificial intelligence pure play. Before we conclude, we have one additional slide with a top-down and longer-term view. This slide goes back a little further than we usually go. This one goes back 150 years. Well, the purpose here is to show how returns have varied from year to year. The purpose is not to conclude that in 150 years we're all going to be rich. Joking aside, of course, you can see a mean return of 8.5% over the last 150 years with a standard deviation of 18.2%, fairly wide. When down years happen, they tend to pull back less than up markets rally. Sharp pullbacks like 2008, well, those are rare. Positive years occur 69% of the time, negative years 31% of the time. So up years in green are more common than down years in red. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.